All right, today we're jumping right into Wipro, one of the real heavyweights in the Indian IT scene. We're going to break this down from the perspective of a serious investor looking ahead to 2026.
You know, the entire IT world is in this mad dash for AI dominance. So the question we have to ask is Wipro a huge, deep value opportunity right now? Or is it one of those classic value traps that could burn a cautious investor?
All right, so here's how we'll tackle this. First, we'll set the scene, then get into the bull case and the bear case. After that, we'll see how it stacks up against its peers, and then we'll give you our final verdict.
Okay, let's get into it. First things first, we need to understand the big picture. Imagine it's April 2026. The whole IT services game is being completely rewritten.
Yeah, this AI-first world, it's not just some buzzword. It's a seismic shift. So when you're looking at a company like Wipro, you're not just buying into what they do now. You're really betting on their ability to totally reinvent themselves. And believe me, the stakes here are absolutely massive.
Okay, with that backdrop, let's look at the bull case. Why would you want to buy this stock? For anyone who loves a good value play, this is where it gets really interesting. And it all starts with the numbers.
The first thing that just jumps off the page is its valuation. Wipro's trading at a price-to-earnings ratio of only 16.6. I mean, compare that to the rest of the sector, which is hanging out around 23. That is a huge discount.
And listen, it's not just a cheap stock. What's incredible here is the quality of those earnings. The company's own CFO says they're turning over 112% of their net income straight into cash. Think about that. These aren't just accounting profits on a spreadsheet. This is real, actual cash flowing into the business.
And that strength, it comes from what you can only call a fortress balance sheet. I mean, look at this. They have basically zero net debt. In fact, they've got almost $6 billion in cash and investments just sitting there. That gives them incredible flexibility, enough to fund huge share buybacks, and it gives investors what they call a margin of safety. It's a huge cushion if things get rocky.
And here's the kicker, especially if you're an income investor. A 5.23% dividend yield. That is hands down the best you're going to find among its major competitors. If you're looking to get paid to wait, this is pretty darn compelling.
Okay, but it's not all sunshine and roses, right? For every bull case, there's a bear case. So let's flip the coin and look at the other side. Despite all that financial strength, there are some very real reasons why investors are cautious and why that stock price is where it is.
And here it is, the elephant in the room, growth. Or, well, the lack of it. While its rivals are growing, Wipro's revenue has basically flatlined. Even worse, profits actually fell year over year. This right here is the #1 issue for the company, and it's the heart of the whole bear argument.
And this chart, wow, this really tells the story of why the stock is so cheap. Just look at the profitability gap. Wipro's return on equity, or ROE, is 16.5%. Now look at Infosys, almost double that. And TCS, a mind-blowing 48%. So for every dollar of capital they have, Wipro is just making way less profit than the competition. They're just not as efficient.
And it's not just about their own performance either. You've got these huge external threats looming. What if generative AI just eats their lunch, cannibalizing their old business lines? What about their big markets in the US and Europe, where companies are getting tight with their spending? And then you've got geopolitical stuff, like new tariffs, creating even more uncertainty. These are not small problems.
So the big question remains, is Wipro a true bargain, or is it just cheap for a reason? To figure that out, we really need to see how its valuation compares, not just to its competitors, but to its own past.
You know, this timeline is pretty fascinating. It's a classic story of what analysts call mean reversion. You can see the stock historically traded in that mid-teens range. Then came the pandemic lows, followed by that crazy peak in 2021, where it hit almost 30 times earnings. And since then, it's come right back down to earth, almost exactly where it used to be. So today's valuation isn't some weird fluke, it's actually a return to normal.
And when you put it side by side with its peers, it's crystal clear. Wipro is cheaper on a price-to-earnings basis, and it's way cheaper when you look at price-to-book. It's discounted across the board, no question.
And here's the thing, this next table basically explains the last one. Why is it cheaper? Well, because its profitability is lower. See? The return on equity, the EBIT margin, they're just not as good as the others. So the market isn't crazy, it's just being rational and pricing in that performance gap.
But wait, this is where the bull argument gets back in the ring. Look at this data. This is Wipro's trump card. Its dividend yield blows the competition out of the water. And that balance sheet? rock solid, way more cash than debt compared to everyone else. If you're looking for a defensive play, well, here it is in black and white.
Okay, we've looked at both sides. We've seen the good, the bad, and the ugly. So, what's the final verdict? What should a cautious investor actually do with this stock? At the end of the day, it really comes down to this one simple dilemma. On one side, you've got these amazing defensive stats, a low price, a high dividend, a fortress balance sheet. But on the other side, you have these nagging, very real concerns about growth and profitability. So you're basically making a trade. Are you willing to give up growth for a whole lot of stability? So, who should buy this stock? It all comes down to what kind of investor you are. Wipro is a textbook value and income stock. It is not a high-flying growth stock. So if you're a conservative type who wants that high dividend and that solid balance sheet, it looks pretty attractive. But if you need aggressive growth in your portfolio, you're probably better off looking somewhere else. And that leaves us with one final question for you to chew on. Investing in Wipro right now, it's a bet on a turnaround that's probably going to take years. So you have to ask yourself, is that fantastic dividend yield enough to pay you for the wait? Because it's definitely going to test